Hello value investors, thank you for joining me. Today I want to talk about DocuSign and why I believe DocuSign is undervalued. We're going to talk about DocuSign's revenue growth rates, then we're going to talk about its billings. Finally, we're going to talk about its valuation. So, if you're new to the channel, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, with balanced arguments for the stocks I own. You'll see high growth stocks with high multiples and low growth stocks with low multiples. I don't like to distinguish particularly between something being a value investment or not, because I'm always trying to find value in every opportunity we go to. So let's get started. With DocuSign, you can see that its revenue growth rates are really stable, and this is really part of the bullish thesis. And everybody knows this side of the equation, so I'm not really going to spend a lot of time here. What I do want to discuss is the billings. So if you know about SaaS stocks, billings are a huge forward indicator of the company's potential. And you can see that for Q1 and Q2 fiscal 21, billings came in very strong, but they start to tail off really rapidly as they get into Q4. And management actually doesn't do away with denying that. They actually talk about in some of their conference calls after the quarter ended, after the quarterly results, that they understand that the first half was very strong, and they did benefit from the rapid acceleration from COVID environment, and that it's not sustainable, that level of demand into Q2. So it's really a case of trying to see that Q2 was very strong, and the second half of fiscal 21 is not going to be as strong. Is that a huge problem? I don't think it is. And when we come to analyze other parts of the business, I think that there's enough here to reward investors paying 29 forward times revenue. So you can see here, analysts are saying that as it comes to lapping next year's Q1 and Q2, revenue growth rate is going to be really struggling here. So from the rule of 40, if you know the rule of 40 well, you see that rule of 40 is a balance between revenue growth rate and profitability. So at this point in time, for Q2 fiscal 21, it was very strong at 55%, but I question whether when we start to exit Q4, whether DocuSign's rule of 40 will still be able to come into 40% or not. So that's a question mark right there for investors. Obviously, DocuSign does have a lot of competition, and I've not really found a publicly traded comparable. Obviously, DocuSign is part of the Adobe family, and HelloSign is part of the Dropbox, but these are not pure play to the level of DocuSign. So if we compare with just other SaaS stocks, we can see the DocuSign is priced at 54 times forward sales, and Okta is another crowd favorite at 34 times forward sales. So with those comparisons in mind, DocuSign is not as expensively priced. So I've tried to go through and show you that there is a strong story here of revenue growth rates. I've put into question marks about its billings and the rule of 40, but on balance, I don't think that investors are paying a large multiple, and a lot of negativity, I believe, is already being priced in here at 29 times forward sales. Thank you for watching. Hope to see you next time. Bye.